Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, November 20th, 2018. Wanted to cover a couple things that I haven't covered recently. Highlight those. We'll start out there talking about some sentiment things that I'm watching in the market that help formulate my opinion. I'll share my opinion where things are going. I'm always glad to do that. Um, and in this case, I'm going to lay out some potential bullish and bearish scenarios. And I do that because it's what I see at this point in time. I try my best to provide unambiguous, streamlined analysis, not, hey, the market can go up, the market can go down. What good does that do anybody? Now, of course, it can at any given time. That's a given, obviously. But I'll share my thoughts. I still believe I'm leaning towards the downside at this point. I'm still leaning towards more downside to hit my final targets. But let me say this because I get a lot of questions put to me. Randy, is it still worthwhile to short SPY or short XYZ company here? And the answer is simply this: as the farther we go down, the closer we come to these support levels, and we become oversold in the market, and we're building these divergences now in the daily time frame. It's plain and simple. The risk reward becomes less favorable. That is one of the keys in trading. If there was a top five list I'd have, one of them would be make sure to use stops, don't fall in love with the trade, let your winners run. But taking trades or investments, if you're an investor, with a favorable risk to reward ratios. I call those an RR, risk to reward ratio, means you don't want to risk $1 of loss to make $1 in profit. If you do that, you're going to have to get it right much more than 50% of the time, and that's not always easy to do. What you want to do ideally, and I prefer at least a 3-to-1 RR ratio, meaning I'll risk $1 to make $3 or more. And so that's where we're going. When we get to the markets, let's jump over there real quick, then I'll get back to the VIX and all this good stuff. Here's the SPY, and these are approximate targets. I suspect that most likely, as I said, we'll have anywhere from about 0% downside if this bullish scenario plays out. I'm not favoring that at this point in time, but I'm very much open to it. And we'll probably know this week. Again, this week could be a little tough with the holidays coming up. But here's SPY right here. And let's just try to take a measuring tool. Let me move that. So let's say we come down and we come back to those, again, these aren't the spike lows at 257 level I have. It's about where trading normalized most of those days. You can see a couple spike lows, reaction lows below there. So to get down there from where we closed today, if I will zoom in here and grab the bottom of that candle, measure it out for you. There's about 2.5% if we undercut the lows, which is what I prefer. I think we'll come in and we'll probably undercut the lows or reverse above them. What happens if all eyes are looking at one level? One of two things usually happens. You either undercut that level, you reverse just shy of that level, like we reversed just shy of today's gaps, or you go on down through it and run all the stops, one or two. That doesn't have to happen, but that's usually what happens. That would just be such a perfect tag at that level. But either way, I'm trying to put it in percentage terms right now for those who are long, have been trapped in this mess. And I want to say this: I often speak of the bulls or the bears. That is just metaphors for buying and selling pressure. Um, I don't wear any bull hat, bear hat at this point in time. I'm bearish and short, but that doesn't mean that won't be bullish and long next week or the following week or a month from now or whenever the time comes. So there it is, about 2.5% downside to maybe as much. And I'll say this: this is my max drop range right now. And let me show you something here. I haven't pointed this out recently. I was noticing this today. Let me tune this up here. Volume at price histogram. There we go. All right, so if you look at the volume price histogram, what it's useful, it shows you where a lot of the trading has occurred. This is volume at a certain price level. So it's like your volume bars down here, except sideways. And what you look for in a volume price histogram are thin zones like this. So you can see up to from here to here, especially this bar here, there's a big support shelf. And we're just flirting with that now. Once we crack below this and we dip briefly below there, and again, this all formed after this, so don't worry about this right now. This is what matters at this point in time. So you get below there, and that is a support shelf. It's comparable, if you will, not exactly the same, but similar to a gap. And if you've traded for a while or invested, you know how how gaps work is a gap is where stock jumped up in price, and so there's a void there. They didn't have any trade. So usually once a gap is entered from above, you go down and backfill the gap, and the bottom of the gap is support. The volume price histogram works the same way. So if we come on down here, if selling begins to accelerate, and we get those forced margin calls and liquidation from the fund redemptions, everything that I've been warning about for a while, then we probably come on down there, and you can see that's a natural support shelf. There's also some reactions there in price, and that I can just tell you right now would be without a doubt my lowermost target at this point in time. So that's about another 6% or so drop in the S&P, and you can see it on a 2-day period chart as well. There's the volume price histogram, and that's that same level right there. Here's your bull market uptrend line. So bigger picture, let me just say this, nothing has changed in the bigger picture. This is a clearly bearish chart. In fact, the only thing that's changed in recent weeks is my scenario. Everything I've been pointing out has just firmed up with all this price action playing out, as anticipated. So we're clearly now below this bull market uptrend line. That was a big rising wedge. And again, I'm sorry, the uptrend line off the 2016 lows, as well as some of the primary bull market trend lines. But there it is. So when you look at it from this longer term period here, this is a 4-year chart. You can see that that would be a natural support level. But again, I think we're either going to come down to it and slightly undercut it, which is where I'm leaning, or we could reverse there. But the point is there's not a lot of downside left, relatively speaking, to the move off the top. And as such, what do you do with that? Well, two things. And first of all, I can't guarantee any of that will play out. The only guarantee I ever make, ever in trading or investing, is that I will be wrong at times. So don't put too much faith into what I say. Take it, with your own analysis, with whatever else you get out there. I'm telling you where I think things are going. But at this point, and again, it's hard to say if I were long at this point, would I ride it out or not? It all depends on where you entered, what your time horizon is, your average cost basis, your risk tolerance, and all that other good stuff. But I think at this point, if you're not already short the market and you don't have embedded gains, I would probably be more interested in looking for putting together a wish list of long setups that you want to ride up the next counter trend bounce. Because I'll tell you, fewer things are more beautiful than a bear market rally or even a short covering rally. This doesn't have to be a bear market. We still haven't hit that 20% threshold, but let's just call it what it is. It's very bearish price action. So forget about the semantics. We know at some point soon we're going to have a bottom and a multi-week rally that will be quite profitable to trade, and you'll have some short covering and everything else. So that's where I think we go near term. I don't even want to show you my longer term targets right now, or I'll just tell you this. If this is a new bear market, and we'll be in one sooner than later if we're not already, I would have to imagine by next year, but this is probably a top. I think we come down and test those old 2015, 2016 lows. And so if you want just bigger picture, if you're sailing around the world for the next 2 years and you want to know what I would do, I would be short down to about this level. But I certainly, again, it's not objective to short here. I'd rather short if I didn't have any positions right now on the next bounce. I'd catch, just wait till this next rally runs its course or looks like it's run its course, and then, swing swing it down. Although, again, I'm an active trader, and there's not going to be short one thing here and hold it for the next 2 or 3 years, because I think there'll be plenty of opportunities on the long and short side, with rallies along the way, even if we are in a bear market next year. And if we're not, charts start to firm up, we start to move back up, take back some of these levels there's a lot of work to be done on the SPY. I'll tell you right now, a lot of work to be done as far as resistance levels. But if we come pop on through them, take back trend lines, take back the 200-day moving average, things like that, then sure, we might be looking at new highs and get another leg in this market. So we'll see. But again, anything's possible. We'll just have to look at the charts and take it as it comes. Okay, and a quick look at QQQ. This rally, really up until today, it's been mostly about QQQ. But I mean by that is today, and this is something I pointed out, and this actually gives, I have a little imaginary column, two columns, a pad of paper with a checkbox, bull case, bear case. So I'm going to check bear case today because I saw the SPY at some points down more, and actually it did. It closed down more. SPY closed down 1.85% versus QQQ down 1.79. What does that tell me? They're going after everything else now. They're going after the safe haven stocks. I saw a lot of, recent high flyers, dividend paying defensive stocks, Coca-Cola, Verizon, things like that that were actually doing very well lately. And this, it was more broad-based selling. That's why you have the S&P down more today than the QQQ, the Nasdaq 100. So you can look at it both ways. You can look at it bullish that, hey, maybe the FANG stocks are starting to be sold out and stabilizing, so therefore the QQQ didn't drop much more than SPY today, or any more than SPY today. Or you can say, well, now they're coming after the rest of the market. Other stocks and sectors are starting to break. So I'm kind of seeing it that way. I hate to say it, but that's the way I'm seeing it right now. We'll see. We'll see what happens. One day doesn't make a trend. All right, levels for you. Let's look at right here on QQQ. You can see the volume price histogram, and really this is where you can see that big. It's almost like a gap. There's that thin zone. I happen to have a line here. I want to leave that line there. That's a support level, but this is where it starts to get thin, right about where we closed today. So if you recall, when we looked at SPY a minute ago, we also had right at the top of the top of the thin zone there. That's where SPY hit today. So consider that again, if you will, not exactly the same, but like coming down and testing the top of a gap. So the market needs to hold support here. As I mentioned earlier, we have bullish divergences, already potential bullish divergences. I have to use that key word. Again, it's just what I call them, potential, because the indicators are heading down and they could blow right through there. Divergences sometimes are taken out. So it's confirmed if and when, in my opinion, we make a higher low before this low, we turn back up, make a bullish crossover. So there's the potential again for a rally from this point, or we can continue down, still keep those divergences intact for a while. So there's, like I said, I'm just looking at that window here. That's my worst case scenario. And on QQQ, I'm sure you guys want that number. Let me move that and grab this candle right there. Yeah, oh no, we closed at the top of it today. So that would be down about 7% on QQQ down here. So again, the range, if assuming today didn't mark the low or we're not close to it tomorrow, then let's just say my sweet spot, my ideal target zone here is about another 2.6 to 5% or so downside on QQQ, and then with the potential about 7%. And I would most likely be buying with both this if and when we got there, but I can only tell you that with certainty as if and as we approach there to see how the charts look, see how everything else looks. Who knows? Market could be falling apart at that point in time, or maybe that doesn't come, until mid 2019. We'll see. All right, so I just wanted to point out the really where we're at. So there's that whole shelf of support, both price support, volume of price histogram, thin zone. So it gets pretty thin in here. And that all plays into that scenario that I'm talking about. If these funds still are being overwhelmed with redemptions, if the pension plans are hunkering down right now because their risk models are breaking, I can tell you that right now. They are breaking. Treasuries haven't been boosting their returns. Gold hasn't. They've been moving up a little bit, but nothing like they have in the past in a similar correction. So you don't have the risk off assets, the defensive assets that they normally flock to or normally fire up in their portfolio to offset the losses. And so that all plays into that scenario, which is a very real possibility. Just have to be careful here, but that would be a sudden and swift move down, and it could happen. Other than circuit breakers slowing things down, it can happen in just a couple days, a day or two, a couple trading sessions. Anything's possible. So just be aware that we're still in a very precarious position in the markets right now. Okay, let's real quickly talk into some of the things that play into my formulation, where I think the market's going. It's not simply the charts, it's not simply divergences or price support or it's everything else that I've talked about. Markets are all interrelated, interconnect. All these things in the financial system are interconnected, and this is the VIX. And I'm just real quick, let me take off. You can see the VIX is, has the same predictive value the stock market does. They tend to move in concert. When stocks fall, especially during a sharp correction, the VIX will shoot up, and that's a measure of put versus call buying. And you can see the divergent lows. These were divergent highs in the market. So again, they aligned with net bearish divergences in the market. So the VIX is like looking at the stock market in reverse. Get these divergent lows, and that's where the rallies come from. However, look at this rally. Let's take a look at it. This was the January drop into the February lows off the January highs. Look how much higher the VIX went. In fact, let's just take a look at a weekly chart and try to put things in perspective real quick. Okay, this is a 10-year weekly chart of the VIX, and these are just, I've had this chart marked up forever. This is the low end of the range, this box. And it used to have a higher low end of the range up until about 2012. Then we entered a period of unprecedented low volatility. Never before. This was never seen in the history of the VIX, this low volatility. And that preceded the sharp drop in early January of this year into the February lows. And what that tells you is extreme complacency. That means the bulls and those long just thought the party would go on forever, and this shows you what happens when things become too complacent. Likewise, if I were to put up a chart, I don't want to get through this video, but these are the big corrections, or the remember, we've been in a bull market for the last 10 years. There's not any bear market within here. These are corrections within bull markets, but this is the range. And so far, we're seeing one of the biggest corrections in years. Like, look at the VIX. I have two lines. This is my extreme range. This is a range when you get to there. Rarely will I sell, calls or options, but that's when in the past, and I've hit those levels, and the VIX is coming down. If you can just ride out a little pain, it's usually not. You got to be quick, but that's the high end of the VIX. And again, I'm not telling anybody to sell calls there or anything, but it rarely stays up there. But what I'm getting at, it shows extreme fear. And that marks the end of the corrections. And even along the way, we've had some pretty decent. Here's that drop into the second drop we had earlier in the year into the, oh no, I'm sorry, we're in 2018, into the February lows was over here. But you can see this is this second line is the minimum fear range. I'd be shocked if this correction ends with such a muted response to the VIX. That's all I'm trying to say. We don't have fear in the market. There's a lot of non-believers in this drop. I don't watch CNBC. I don't turn on the media. I read the paper. I read Barron's, Wall Street Journal, other things. But from what I hear, people on the site, that the cheerleader marching the cheerleaders out in full force, the cheerleading squad on CNBC, they can't understand why Apple's dropping everything. And again, they're not showing fear. And again, those are the bobbleheads on TV. This is where I like using these charts, not sentiment surveys or not what people are saying on TV, because this shows you where people's money is, not where their mouth is, as another one we'll get to here. Okay, so this one's actually where their mouth is and not the money. This is the AAII Bull Bear Sentiment or survey, AAII survey. And what it does, they survey market participants as to whether they're bullish or bearish. And I like any sentiment survey, whether it's including the VIX, any sentiment measure, I only find any predictive value when they're at extremes. Anything in the middle to me is absolutely useless. I've studied these charts till my head spins, and over the years I've learned ignore them until they hit an extreme. And so years back, I've had this chart up here for years. This red zone, I colored this red at the top. You can see the line right there. So that's the red zone. And when it gets up there, that shows extreme readings between bull bear spreads. And you can see the dotted lines. All these dotted lines show you when these readings come, boom, you get the corrections. Readings come, you get the corrections. There was that big drop back in 2015, 2016. We had right before the January highs, everybody, yes, was about, they were as bullish as they'd been in years, the vast majority. And we had those two big corrections earlier in the year. Where are we at now? Nothing. There's no fear. Now, obviously, for a bottom, you want to see the extremes down here. Let me just make that clear. So you see the extremes that marked the end of the bear market back in 2009. You had some extremes along the way there. That was the biggest extreme. The extreme line on the bottom isn't as well defined as the upper band, but you get the point. You can see we had an extreme some extreme back-to-back bearish readings, and that marked that bottom of that sideways, almost bear market back in 2015 into early 2016. What do we have so far? Nothing. There's no fear right now in this market. So again, this is one of the biggest drops so far. Market action, price action is as bearish as I've seen in some time. So I'm just looking at this and saying that what regardless of what happens this week, I don't. Nothing smells like a bottom to me yet. I don't see capitulation, panic selling. I don't see what appears to be a selling climax. That's a very high volume spike on an extreme, red candle. Um, Nothing's really pointing to very strongly, I should say. Nothing's pointing really strongly to a bottom at this point. Okay, and the last one here, this is the CPC, which is a CBOE options total put to call ratio. So as the name implies, it measures the ratio of puts to calls. If investors are bullish on the market, they buy calls, and if they're bearish, they buy puts. So the higher this goes, the more bearish they are. You can see I have a green line and a red line. Keep it very simple. And of course, yes, those are at extremes. Anything in between is just noise, in my opinion. Um, if you can pause the video, it'll probably take too much time to walk you through this in detail, but all the dotted lines here that I have, the dashed black vertical lines, those are when that extreme high was hit, the green line there. So when we hit or cross that level, and if you follow it down, you'll see bottoms marked. Even if it was a bear market rally, like back here in the 2008 meltdown, there was a nice bear market rally to trade right there. We had a low. This one signaled a little early, but yeah, it's not perfect, but it just gives you an idea of where fear is. So again, when this spikes high, there's a lot more put buying than call buying, and it often marks the bottom. Now you might say, well, what are these arrows? These arrows mark down here, the red dotted line marks the extreme complacency when everybody's bullish. They're all buying calls and not a lot of puts. And so those arrows, I don't have the vertical lines there, but I have the arrow that marks the high that came right there. So, and the reason these lines are so close together, as I often say, stocks tend to fall a lot faster than they rise. Corrections are super profitable to trade, but you got to get in, get out. You can't stay late to the party, especially during a bull market like this. If we get into a bear market, everything happens in reverse. Just like in a bull market, if you happen to have bad timing and you buy in right here, stick it out long enough and the market will bail you out. Same thing will happen in reverse in a bear market if and when the next bear market comes, where you'll get bailed out for shorting at the wrong time as long as you hold on to things. So there it is. So the arrows again show you, and this was an extreme cluster. Remember, this was the worst correction since the entire bull market started back in 2009, and that was preceded by a triple tap reading. I call it 1, 2, 3 extremes at my red line. It was pointed out back then at the time, and then boom, we had a big correction there. Actually, from high to low, the markets fell more than 15%. That's just on this, the closing values, I believe here. Either way, so what do we see? I had one extreme. We had an extreme here. There's a buy signal that came after this little pullback. Again, it doesn't look like much. This is a 10 plus. No, this is a 12-year chart. So you can't make it out, but that was a pretty decent correction. And then the only other time we've had extreme fear came right after here. This is that January and back-to-back correction, January to February lows, and then the lower low right there back in early April it was. And you can see, boom, that told you there was a lot of fear, and that was a time to go long. What do we have now? Nothing remotely even close to that line up there. There's just no fear right now in this market, and because of that, hey, anything's possible. But I don't think the bottom's in until we start to see some fear coming in this market. And if you're new to trading and investing, you wonder how that works. If you're not, it's not making any sense to you. When the fear comes in the market, they're buying. When people buy a lot of puts, first of all, you have a couple things happen. Longs capitulate. They sell the weak. No offense here, but I mean the weak-handed longs that are shaken out, and it leaves a core holders. Those people there's people that'll hold. You have to pry their apple out of their cold dead hands, and then there's people that bought it recently near the highs and they're down 10% and they want out. Those are what I call the weak-handed longs, where you have a core holder. So any stock in the stock market itself, when the market bottoms here and flushes out, those still holding, they're not going to be shaken out on a 5-10% pullback. If they held through this, they're holding, they're holding for life, or at least for a long time, till they need that money. So that's what I'm talking about, the dynamics of the market. And so until you get that on a nice flush out move, you shake out the weak hands, and then you ramp up two things: short sellers. more and more shorts want to come in late, and then boom, when the market reverses, they add fuel to the advance because they start to have to cover. They're underwater, and you also, when you have a lot of put buying, a put is a bet that the stock market will go down, or a stock or an index, and so those bets, if they're too one-sided, it works in reverse. It's going to put a floor in the market when you have the extreme, a lot of put interest in the market, because one thing the market's efficient at, especially the put and call, the smart money, they don't buy options, they don't buy puts and calls, they sell them. It's typically, and again, no offense, it's called the dumb money. It tends to buy puts and calls, retail traders or smart money trades, and they do that because the vast majority of options expire worthless. So when you have a lot of put buying, it is a combination of institutions, aka the smart money, hedging up, but it's also a lot of retail traders. And same thing when you have a lot of call buying down here, everybody's bullish, and because of that, the market's not going to go up. Okay, and we'll wrap this video up with the index charts. This is the SPY 60-minute. I want to get down to the nitty-gritty, the shorter term time frames. I wanted to leave these on here even though they were burned through, just to point out that we did burn through those divergences. So I pointed out the other day we had potential divergences. The bulls certainly had the opportunity to put in some divergent lows. They're still there on the futures, but it's better if you see them on the index ETF. So SPY has been backtesting this trend line. But I will say this. This was I think I've mentioned this yesterday, even in recent videos, 263.44 is pretty much a last-ditch support level. And as much as we dropped today, we bounced along that level all day. You can see that's what we've held. The SPY held that level. So far it's held support. You don't have to have bullish divergences to rally, but the fact they've taken them out kind of chips away at that case. But I do want to say that's a level to watch. And I think tomorrow, or doesn't have to be tomorrow, within the next week or so, again, we have the holidays coming up. Markets are closed in the U.S. on Wednesday, abbreviated trading session on Friday, which will be light volume. So maybe or maybe not, and this has to, might carry over till next week. And so even if we can bounce tomorrow, there's still a lot of resistance up here. Today we tried to go up and tried to backfill the gaps, and we got shot down on SPY, but I think this is a pretty significant resistance. And if you're a bull or long, this is a level you want to see. This gap right here, this big today's gap, get taken out and then some. Big green candle, not just a little brief pop above there, but a solid green candle. If you're intraday trading, look for a 60-minute close and a couple more green candles following it. That would be bullish. Otherwise, if we do happen to pop up there and we get a rejection, we come back down here again, we're probably going to break these levels and they'll probably kick in some waterfall selling. So those are the levels to watch. We closed right on support. Have a lot of work to do overhead. If we take that out, we continue to move up. You can see the resistance levels there, so the market certainly has its work cut out for it. But if we start to get a rally, we'll just have to look to see how impulsive it looks, how convincing. But again, we've seen some of those recently that looked, I guess, convincing is convincing. You get an impulsive move up, and you can't knock it, but we'll see what happens. Here's QQQ, broke down, just looks ugly. We had potential divergence. It's been burned through. We took out that 162.20, what I called that last ditch nearby support, and that's now resistance. So if we can bounce back up, that's right about today's where we gap down. So you can see we closed on that support yesterday. Gap down today, went up for a backfill, and I mentioned this in the trading room. I said too many eyes will be on that gap. I didn't think it would be filled. I figured the sellers would step in early because it would have just been too perfect an opportunity to, for shorts to pile in, and so it did. It reversed. I know a couple traders in the trading room caught that too. Were able to get on the bounce and ride it down into the close. So those are the levels to watch. Bulls want to see this 1620 level get taken back with conviction, and then of course there's some work to be done if that does happen. Otherwise, we're probably going lower. I'll just wrap it up here with the futures. NQ, as I mentioned, barely by just the skin of its teeth hanging on to this potential bullish divergence, about equal lows in the RSI, about an equal low in the PPO. But with lower lows and prices, that still counts as divergence. But it's not very impressive. The price action so far, you can see that we went down. We had the bulls put in a big green bullish candle today. So they certainly had the opportunity to take it and run. And again, guys, when I talk bulls and bears, I'm just metaphorically speaking of buying and selling forces. I am not trying to, stereotype anybody. I don't care who wins this battle. I'm just want to be on the right side of the trade. So I'm just speaking again metaphorically. And I think I mentioned this in the trading room too. Yes, I did early this morning that this right there was resistance. You can see the minor resistance, and that's where we stopped today. So we fell short of those gaps. And again, we faded a lot of that big green candle. That's not what you want to see if you were a bull. Again, they had the onus was on the bulls to take it and run after that big green engulfing candle right there, that big bullish candle, but they failed to do it. And finally, we'll wrap up with ES for you ES traders. Again, the S&P 500 was unusually weak today, and that just shows more broad-based selling. They just like NQ I showed you a second ago. We have the potential divergences still hanging on by a thread. That really they don't have much more room for downside. If we go down below today's lows tomorrow, those divergences should be taken out. Um, and you can see we had a big green candle intraday, and then all 100% and then some faded. SPY went on, or ES, which we're looking at here, as well as SPY, went on to undercut their lows from earlier in the morning and close right about on those lows. So this, again, speaks to what I was seeing today, the common theme that the S&P 500 being the weaker of the two indexes today. And it shows me that now we're getting that broad-based selling, which I attribute to the funds being squeezed, ETFs, mutual funds, getting redemptions from investors. And if they don't have the cash on hand, they have to sell. It's not an option. They have to meet settlement on those liquidations, and they sell what they hold. And most in recent years, there's been an unprecedented trend towards index investing. That's ETFs, mutual funds, and it works great on the way up when money's flowing in, but on the way out, it's going to work in reverse. Those funds will have to sell those stocks, and fundamentals do not matter. And that's where I think these guys on come out. I heard they were somebody in the trading room said they were just screaming at each other over Apple the other day on TV, and that's what they don't get. Fundamentals don't matter when you're in forced liquidation mode, forced selling. So that's what's going on here. The news, the headlines will follow, iPhone sales down, all that other stuff. But either way, I'll wrap it up here. And again, I think we're getting close to a bottom, both in time and price. I would put it at probably within 2 weeks, most likely by the end of next week, because at this point, if we're at where I think we're at, you don't limp down from here. You're going to have a couple big down days, and then it's going to be over, and they probably be uglier than today. Again, that's the bearish scenario, and then those targets get hit. And so the good news is, if you're riding this out, that should happen pretty quick. Again, there's no guarantees. There's no guarantees. We can't go down more than 5, 6, 7%, but that's about the extreme of what I see right now. And we'll have a good idea soon whether these divergences can start to play out or not. And all right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. I know this has been a long one, but I hope you enjoyed it. Hope it was worth it. Have a great day.